So for more on the infrastructure battle shaping up, let's bring on Tom McLoughlin, head of America's fixed income at UBS Global Wealth Management. And Tom, the gap between 600 billion and 2.2 trillion obviously is large, but spread out over the years that this plan would go into effect. I mean, talk to me about how much you're expecting this to get trimmed, and then how you see it playing out in the years to come.
Yeah, I think good morning, Zach. I think the probability is that we're going to see a package which is probably 40 to 50% lower than the president is actually proposing. The centrists in a closely divided House or Senate are always going to be the ones that basically dictate the outcome. And Senator Manchin has basically made it very clear that he wants to both focus on physical infrastructure, what we might call traditional infrastructure, as well as basically trying to meet some of his Republican colleagues halfway. So you put those together, it really leads you to believe that at some point, the president is going to have to basically scale it back. Now, having said that, he's going to basically make a State of the Union or a presidential address to Congress, I should say, on Wednesday. And when he does, he's probably going to roll out additional initiatives. But I think this is a 5 or 6 month process, and we're going to basically be at this all the way through into October. So what you're seeing right now is Senator Manchin and other members of Congress positioning themselves for a very long, drawn-out compromise negotiation.
Tom, this is Emily. I want to ask what sectors or specific companies you see as being the biggest beneficiaries of policies under this eventual, potentially more moderate plan, as it is likely to be passed. Since, we've been talking about green tech, semiconductors, financials already getting a boost since the election back in November. Have some of these stocks just run up too much given where this infrastructure bill may eventually shape up to be?
Well, I wouldn't say, Emily, that they've run up too much, but you've seen industrial stocks do quite well over the course of the last 3 months. We think some of those have basically run their course, but there's still others within the industrial sector that should perform well. Materials is another sector that, quite frankly, should do as well, and we're expecting that to continue to run. Financials are the beneficiaries of slightly higher rates and particularly a steeper yield curve, and that's been a story that's been in place for the last 2 or 3 months. You mentioned green tech. I think that's basically, regardless of what happens in terms of the outcome with the president's proposal, it will be scaled back. But that particular sector, we can call it a new sector, green tech, is actually going to do pretty well over the course of the next year or two as well.
Yeah, it's interesting because you can say that would be an obvious piece of his plan that would be in the crosshairs and coming down, but also just kind of across the board, less money being spent on even what we heard Senator Manchin talk about as traditional infrastructure, including cuts to wastewater and energy grid as well. But when you dig into kind of the impact of all of this, of course, the bigger price tag comes with worries on the corporate tax front and capital gains taxes also being something we talked about last week being floated. So how do you see maybe the impact of a trim proposal having on the need to raise taxes as President Biden has laid out?
Well, it's actually, they're kind of linked to the extent that you basically scale back some of the proposal to a point where it's probably 60%, let's say, of what the president is initially proposing. It also basically allows you to basically have some flexibility in terms of the pay-fors, if you will. There's no expectation that you're going to have taxes pay for the entire program. We're always, regardless of how this plays out, you're going to have some reliance on additional funding from the government through the issuance of debt. So you can expect the deficit to increase again. But to the extent that you scale back some of this, then the pay-fors, the additional tax increases need not be quite as high. And that's just one contributing factor to the expectation that we don't anticipate the corporate tax going to 28%. I think 25% is probably a more reasonable expectation. And in terms of capital gains taxes, the market reacted on Thursday. They seemed to adjust again on Friday. There was a little bit less consternation, a little bit less anxiety as to where that was going. You have to remember that there's no relationship over the course of the last 45 years between capital gains taxes and the performance of the equity market. If you run the numbers, you can see situations where the PE multiples were as low as 10 when the capital gains rate was 20%. They were as high as 18, the PE ratio, when the tax rate was 35%. So it goes in many different directions. And I think what happened on Friday was that the market woke up and realized, you know what, this connection, this nexus isn't there. Now, having said that, we also do expect the cap gains tax not to go to the 39.6 plus the net investment income tax. It's probably going to be a statutory rate of something on the order of 28%, plus the NII, so you might get a little bit over 30%. So it's not going to be quite as egregious or as high, certainly, as what Biden is now proposing, I think.
Well, certainly something the market will be watching as these discussions continue in the coming months. But thank you, Tom McLoughlin, UBS Global Wealth Management, Head of America's Fixed Income.